Hey investors, it's Adam Carlini and Grant Haddon with Dynamic Wealth Management. What is this elephant in the room? Oh, it's got my name on the bottom of it.
Rub it in. Rub it in.
So Gary has won this the last couple of years. Grant had victory snatched from him in the very last moment last year, and Gary took it again. But this year, the tournament's not even over yet, is it?
There's still 4 teams left.
However, I am in an insurmountable lead, and so Gary graciously has bestowed upon me the trophy for winning the NCAA bracket contest here in our office. We also are still having this contest with clients and potential clients who are out there, have joined our brackets. We're excited to watch and see how things finish up. Just kind of a funny note, I picked my name this year as Sparty. Sparty. Michigan State got blown out in the first round, so I didn't think I had any chance, but stranger things happen. We all had Michigan State going to the finals. So we'll set this aside now and get onto things of less import. So we've had quite an interesting week in the markets. We've had Janet Yellen come out and speak. We've had a bunch of Fed FOMC members speak. Let's get right to it.
Yeah. In the email today, we're going to send out also the current standings if you entered into our March Madness pool. So we'll put the standings in the email as well. But let's jump into things and show you what's happening in the market. Okay, investors, welcome to our video. We're going to start out with walking you through a couple of upcoming events that we have. And then we're going to jump into the economy, Janet Yellen, the stock market, and tell you about everything you need to know about investing in today's current marketplace. We want to start off by letting you know, as always, we have a meeting every 2 weeks here in our office. It's every other Tuesday. The next one will be on April 12th. It's called Investments for Breakfast. Everyone's welcome. Everyone's friends are welcome. It's just a group of people that we all get together and talk about where we're invested, why we like certain things in the market, why we don't like other things, and share our experiences. Talk about where the market is. As far as formal seminars, we do have one of those coming up in Sun City Grand. We are doing this on April 21st, and that'll be 5 o'clock dinner seminar. Everyone's welcome to come to that as well, find out who we are, what we do, and why we're different. Just give us a call to RSVP to those events. Okay, here is our risk indicator. So if you've been watching our videos, then you know each video we give a market indication as to where we think it is, whether we think it is a good opportunity to buy, or if it's just kind of in the middle, or if we think it's a bad time to be buying and more of a time to be selling. And right now we think it's there is some upside to the market. Now, this indicator moved green a couple weeks ago, and we were hesitant to buy into a more aggressive position because of where the market was and resistance levels overhead and many different factors. So we still are taking positions, but strategically taking them a little bit more at a time and getting to a target allocation that is green. Actually, just today we took 2 more positions on the equity side, a little bit on the technology side, and the other one was on the dividend side. So we are taking more equity positions to get to a green allocation, but we're not all the way there yet. We're buying a little bit at a time, strategically trying to get to where we want to be as efficiently as we can. Let's talk about a couple key things that have happened recently in the economy. So Janet Yellen came out and was speaking for the Fed and said that global uncertainty justifies slower path of rate increases. So this is what the stock market's been scared of, that the Fed are going to be raising rates, which generally is bad for the market. So this, for the stock market, is great news. The Fed comes out and says, we're not going to raise rates. Actually, we probably won't raise rates until after the election. So they're kind of giving the market the green light for the rest of the year to say, hey, we're not going to raise rates, so if you want to buy, go ahead and buy. And the market has had some strong move off of that news. Now, here is some of the language that was used there that really is changing people's perspective on the market. So she starts off by saying, given the risk to the outlook, I consider it appropriate for the committee to proceed cautiously in adjusting policy, right? So they're going to be cautious. They're not going to move anything too strongly. The major thing that changed between December and March that affects the baseline outlook is a slightly weaker projected pace of global growth. So she's talking about, well, we're worried about global growth in the economy, right? So then we come down here, and should the economy take a turn for the worse, then the very last statement here, she says we could launch a new round of asset purchases. So right there at the end, she decides to tell everybody we actually could start stimulus again. And of course, the market has loved stimulus in the past. So I think that's kind of making people comfortable in the marketplace. They're saying, hey, if the Fed is telling us that if things get bad, well, they're going to start asset purchases again, well, then why not buy? And that's why we've seen a little bit of uptick in the market. If we are looking at the next meetings of the Fed, in the very next meeting, there is a 7% chance that they are going to raise interest rates in April, and in June actually the probability is only 21%. So what we're figuring out is that they're really most likely not going to raise rates till the end of the year, if at all, for the rest of 2016. With that being said, I'm going to turn some time over to Adam and let him talk about the stock market and how this news has affected it.
Okay, so what does all this mean? Well, let's see how it translates into the stock market and the charts. So, first off, you'll notice that the 10-year yield and the S&P 500, representing the stock market, have been kind of in a lockstep. When the one's going down, the other goes down, and it moves up, and it moves down. Notice, however, that sometimes the bond market and stock market move differently. Here, the stock market's moving up, while the bond market is moving down. Oftentimes, in fact, more often than not, if the bond market is showing a down move, and this is yield, by the way, declining yields, then it means that when it moves down, the bond market tends to be right more than the equities market. And so this little rally the equity market had, the bond market was saying, nope, that's wrong. And then sure enough, the stock market then realized it was wrong and it went down further. But now we've got an interesting divergence going the other way again. Now we've got the stock market moving up and the bond market with the yield going down, saying that money should be going to bonds. And so if these two are supposed to follow each other, yields and stocks, then you would think that if bonds are right, they should pull the market down. And yet the market at this point diverged, has been rising. Is it ready to roll over? Well, Janet Yellen basically changed all that. So on this date right here, it looked like the stock market was going to follow the bond yields down. Until Janet Yellen came out and shocked the world and said, no, we're going to keep rates the way they are. And then the real zinger, we might even have to stimulate. What? Might have to stimulate? You guys just raised rates for the first time in 9 years in December. So all of a sudden the stock market is saying, oh, we're off to the races because now the Fed's got our back. Well, they really can't stimulate by cutting rates, but they can start purchasing bonds again. And that's got the stock market excited. So we saw this big move up here. We got a little move up on the bonds, but the stock market had a big pop off of that. And that really changes everything. So previously, as we saw this market melt down, it was lower lows and lower highs, and then the big plunge. This has been our bottom range, and this has been our upper range. The market managed to get back above that range, but still we did not expect it to get much further because we had this declining trend line that would be right here. And in fact, when it got to that point, it slowed down, came back down, looked like, okay, here we go. We got this little rally, but it's not enough to get us to new highs, and down we go. And then out comes Yellen and says, yeah, we might even stimulate. And now the market is saying it could go much higher because of that. Will it? That's going to be the question that we must answer. There are a number of reasons why it shouldn't go higher. We've got, corporate profits have been weaker now for more than 4 quarters. The pro forma earnings reports are showing a much wider gap between pro forma and GAAP accounting figures, which means that the companies are having to fudge their numbers more to try and make things look good. So we've got those things working against us. Seasonally, it's still positive. Typically, we have more up markets through May. So it'll be interesting to see how things resolve. Let's look at some other things that might give us a clue. You'll notice we had this nice uptrend going for a long time, this channel, and the market flattened out and it started a downtrend. One of the reasons we were reluctant, even though the one of our indicators, the one that shows you crossing over from green or yellow or red, crossed back into the green. Now we took it when it crossed into the yellow, but it recently crossed into the green. However, because of some of the things I just mentioned with interest rates and the expectation for higher interest rates putting a damper on the market, and with the fudging of numbers and the weakness in the economy and the fact that we're right at the top of this downtrending channel, and we're at the top, gave us pause and said, we really don't want to add more money right here just yet. We need this market to prove itself. Bond market's saying it should be headed down, and so let's wait and see. Well, the other reason for waiting and seeing is when we get a crossover like this on the MACD, when it's above, when this crossover happens here, for example, when it's above this zero line over here, that's a positive thing. So you can see a market rally off that. But when it crosses over and it's below this zero line, then it's not as strong of a signal. In fact, it's usually a bogus signal. And you can see that while it rose here, it sunk back down to deeper lows. And again, it was looking like it was going to turn back and probably get to deeper lows. And so we didn't really want to put money to work just yet. However, given the recent news from Janet Yellen saying that, no, we're not going to raise rates, maybe one more time, and probably even we would even stimulate if we need to. This is out of nowhere. The market has gotten very excited, and we feel that we have to now take positions. So we did reestablish more positions in the green zone yesterday, and we expect that those positions should benefit, at least in the near term. We'll see if this can carry on. Maybe earnings season, we can get an upward boost from earnings season because we've got such lower numbers to beat. But usually at the beginning of earnings season, you have kind of a pullback. But with this new news about even possible stimulus, and we're not going to raise rates, and this is after all of last week, all of the Federal Reserve talking heads kept coming out and saying, oh yeah, we're going to start raising rates, maybe even in April. And then Yellen comes out with something exactly the opposite. It's just got people scratching their heads. Does the Fed even know what they're doing? But stimulus is much more loved by Wall Street than rising rates, and therefore we're starting to see a move upwards, and we've positioned ourselves to take more advantage of that. Looking at the dollar, you can see the dollar was rising. That's because interest rates were expected to rise. Then in December, they finally raised rates, and what happened? The dollar declined. That's not supposed to happen that way. And so we've seen a decline in the dollar. It tried to rally back up, declined further. This right here is the last week where all the Fed heads were talking, saying, oh yeah, we're going to raise interest rates. If you're going to raise interest rates, then the dollar usually goes up, gets excited, and then Yellen comes out and says, no, we're not raising rates. We might even cut rates. And bam, down it goes. So the dollar is sinking. That is good for large multinational corporations who do a lot of overseas business. So consumer staples is good for. The interesting thing, though, is staples and utilities, which have been the strongest sectors, are defensive plays, not offensive. So this market, the jury's still out, but we do think that the market can rally for a bit on this recent change, and therefore we're participating now, more so than we were before. Here's another strange thing. So oil is priced in dollars. Oil doesn't like a higher dollar. You can see it was declining and declining and declining. That's not all because of the higher dollar. It's also because of supply and demand issues. But then we get this big rise on a declining dollar, and then all of a sudden the market's coming down, and that makes sense because all the Fed heads were talking about increasing interest rates, and that would hurt the dollar. That would strengthen the dollar and therefore hurt oil, and so oil was getting hurt. And then Yellen comes out and says, nah, we're not gonna raise rates. That weakens the dollar. You would have expected an oil rally. We didn't get it. We did not get an oil rally. That suggests the oil market may have topped out here and is going to test back lower again because it's moved lower when it should have moved higher. So Up until now, we've had this pattern where oil and the stock market have kind of moved together. Now we're diverging. If oil is going lower, before it seemed like that would push the market down. But now with this Federal Reserve put, we used to call it the Bernanke put, basically he would do whatever it took to keep the market up. Now we got Yellen saying the same thing. So with the Federal Reserve supporting things, that suggests that the market could have a little more up move here. Will it break to new highs? That remains to be seen. But we are participating more in our ETF model as we've reluctantly taken another position based on this recent move, this recent change of news out of Yellen. So, what does that do to model allocations? As I said, we've already poked into out of the yellow zone back into the green zone. But as I said, because of the movement of the market and this decline, it looks more likely that we're going to see lower lows and a decline. We did not want to take positions this high up. So we held off until this news from Yellen. With this very dovish news, we've taken more positions. The positions we took are in technology and in dividend-paying stocks. So we'll gradually move back to a fully green position, and that's what we've been doing. What does that mean for the allocations? Well, we're technically in the green zone, but we're not yet to the full risk on of 60% in the conservative model. We're at 45-55 here, so we're getting there. If it's 45 is up from 30, and we'll add another 15% as well. So defensive assets, again, these are defensive assets we're decreasing, increasing the risk assets in each of the models until we get back to this full model allocation. So here's our disclosures to keep the attorneys happy, and we thank you for listening. We thank you for your confidence and trust, and for the opportunity you give us to serve you and help with your investment needs. If you've not yet met with us, we invite you to do so to learn how we can help you. Also, if you'd like to diversify and have more exposure to the markets, the ETF core model is a great model, but we also have a market leaders model that's fully invested all the time, as well as a dividend model that remains fully invested and benefits from dividend payers, which benefit from lower interest rates. Both of those models make sense as diversifiers to add to your portfolio. You may want to talk to us about that as well. Thanks, and have a great weekend.